been a recent proposal by Senator Elizabeth Warren to tax book income at a rate of 20% above a threshold of $100 million. And I just want to talk a little bit about what that might mean, a little background on information on that, and talk about what I think the consequences of such a proposed tax would be. So as a beginner, the corporations, especially public corporations, calculate their income in two different ways. So the first way they calculate their income is according to generally accepted accounting principles. So the goal of generally accepted accounting principles is to convey economic reality for a public corporation to shareholders, to debt holders, to the general public, and so they can know how a company is actually doing. So you want to know whether to invest in a company's stock, you can see their earnings per share and see how profitable they are, and you can make a decision based on generally accepted accounting principles calculated earnings. It's what we call book earnings. So this is created by the Financial Accounting Standards Board, again with the goal to reflect the economic reality of the firm. The second way in which companies calculate their profits is according to the Internal Revenue Code. So the Internal Revenue Code creates taxable income. This is legislated by Congress and serves as the tax base for corporations. So we apply our 21% corporate tax rate against taxable income, and that's the way we earn revenue, or we raise revenue as a country. So the goal of the Internal Revenue Code, again, is to create a tax base to raise revenue, but also to change the behavior of companies. So for example, Congress has decided that companies don't do enough research and development naturally, and so we have an R&D tax credit embedded in the Internal Revenue Code that encourages companies to do more in R&D. So the proposal, as I started off with, is to tax book income at a rate of 7%. The challenge with that is that book income was never meant to be taxed. It was meant to convey economic reality to stakeholders. And I think that there would be two big consequences if you started taxing book income. The first is that companies themselves would change the way that they calculate book income. So if people who are proponents of this tax say that if you tax book income, this is great because companies aren't going to want to manipulate book income down. They want to convey as high income as possible to shareholders, so they're not going to manipulate income to pay less in tax. The challenge with that is we actually had a tax in the 1980s, passed in 1986. It was part of the corporate alternative minimum tax that had as a basis book income. And we have some good economic evidence that companies actually did manipulate income to pay less in tax. Now there's two problems with that. Is first of all, you get less revenue than you intended to raise. But second is that companies are manipulating this book income to pay less in tax. And so book income serves as a less useful basis for shareholders. Shareholders can't look at that number and know what the economic reality of the firm is because companies have manipulated that number in order to pay less in tax. The second thing that would happen if we tax book income is that the Congress would actually start to manipulate book income itself. So one of the big kind of bonuses or good things about taxing book income, according to its proponents, is that the taxable income isn't really a reliable way to assess profits, that it's been riddled with so-called loopholes, that lobbyists have had undue influences in the calculation of taxable income. And so we should move to taxing book income, which hasn't faced these problems. It hasn't been so affected by lobbyists. Well, the reason why lobbyists haven't changed or haven't tried to change GAAP income, book income, is because it hasn't been taxed. The moment that we start taxing it, Congress will influence the FASB to change the calculation of book income, which again would be another way in which book income would change. It would serve as a less useful basis for financial markets to understand how corporations are doing. So the proposal, again, to change book income or to tax book income would end up changing book income. It would get distorted by companies themselves trying to avoid the tax, and it would get distorted by Congress as it faces the same lobbying pressure as the Internal Revenue Code currently faces. So, based on these two reasons and many other reasons, we believe that taxing book income is a bad idea.